tools for the forward-thinking investor like you in 2019. There are a number of different products and investment platforms that exist. We'll give you a brief overview of what we're using and why, ensuring that you're in the right asset classes and using different products to make sure that you're invested in the most effective portfolio possible and protected when one asset class drops.
Okay, jumping right into tools. So there's a companion blog post that goes through a lot more details and has links to all of these. But what we're going to jump through is the tools that I'm using right now. So for a portfolio manager, there's two. There's good old-fashioned Excel, which works really well, especially for these rather esoteric investments that don't have an online account. For instance, you've invested in your buddy's startup or something like that. Excel always works really well for aggregating all of this data, putting it into a format that makes sense, where you can kind of see how much of your capital is allocated to each asset class. Another tool that works really well is Personal Capital. So this allows you to peer inside of your asset allocation, specifically with stocks. It does a really good job, so you can see which sort of sector you have a lot of exposure to, how that relates to the S&P 500. So maybe you have way too much investments into IT or healthcare or banks. Way too much is relative, obviously, but you can use this tool to peer inside of your mutual funds and ETFs and stock holdings and see how much of your capital is allocated to different sectors, different nations, different geographies. It's very, very useful, and they have a free tool that's very helpful. Cash is arguably one of the most boring investments. So obviously, as part of your financial plan, you should have an emergency cash reserve. So this is putting aside a little bit of cash, it's your rainy day fund, just in case you get out of job or had an unexpected expense come up. But the idea is that you don't want this cash just sitting idly in your checking account, not earning any sort of interest. So Betterment has this cash sweep function. So they're also a robo-advisor and have some pretty cool tools and functions available there. But I use it specifically for the cash sweep. So what this does is you hold your money in your checking account, which you can connect to all of your bills and everything like that. So ideally, you'd be having your salary come in and all of your expenses come out. So ideally, you should have a little delta at the end of the month. So what Betterment does is it tracks your spending, or you set up a threshold. So you say, I want $4,000 cash in my account every month. And if you deposit more money, say you deposit $10,000, then it says, hey, you only wanted $4,000. We'll take that delta, that $6K, and we'll put it in this high interest savings account and earn you a little bit of extra money. Then as soon as your checking account gets a little bit lower and hits that $4,000 mark or below, so say it goes down to $3,000, Betterment will say, uh-oh, you've hit your threshold. Let's shoot over $1,000 from your high interest savings account into your checking account to make sure you maintain that $4,000 threshold. Cash is a very boring investment, but getting a couple extra percentage yield on this investment is very nice. So I've been using Betterment for a few months now, and overall I'm pretty satisfied. Stocks, passive. So there has been a massive rise of robo-advisors over the past 10 years, 5 years. I've used a number of them. There are a number of them that exist. However, I was a big fan of A Random Walk Down Wall Street. The author of that company, or of that book, is the CIO of Wealthfront. I've been following them since early days. What they do is they allow for easy investing into the stock market or the markets. So for me, the way that I use it each month, each week actually, I pull money out of my checking account and invest it directly into Wealthfront. So this cash that's invested into Wealthfront, so say it's $500, goes into Wealthfront and buys a number of different ETFs based on my asset allocation that's based on my risk tolerance. So this is a very, very easy, low-cost way of getting broad-based exposure, passive exposure to the stock market. They do this for an extremely low fee, and they have some really, really cool features such as tax loss harvesting. So the amount of tax loss harvesting that I've generated over the last couple of years have more than covered the added expense of Wealthfront performing this service for me. Tax loss harvesting is something I used to do manually. Took a long time. I'd only do it 1 or 2 times a year and not very effectively. So having this in the background, constantly doing it for me is a huge help. Next tool also within stocks or traditional assets would be a broker, a good online broker. So Fidelity is the one I use. There's a number of other ones out there. I've been using Fidelity for a long time and have no real complaints. And at this point, it's a little bit of a sticky business. I have a lot of money there, and that's where it's very easy to use. So I use this for allocation to gold, fixed income if I'm buying individual bonds or munis, individual stocks if I want to pick some few individual stocks and do very badly with them. I also buy public REITs, so real estate investment trusts, as well as mutual funds with this account. Getting a little bit more into alternatives. So the previous 3 were more of traditional assets. So these are stocks, bonds, and cash. Yes, within the online broker, you can have access to gold and public REITs. So these are a little bit more of alternatives. But these next tools are more alternative. They're separate platforms. And this is where personal capital really gets very useful in that it can aggregate all of these online platforms into one portfolio. So you can really see, okay, how much do I have in alternatives? How much do I have on these different platforms? What's my risk? Because these are startups, so I have money invested with them. Some of them are insured, but what happens if one of these startups goes under? You know, how much exposure do I have to each of these? So the first one I'll start off with is private REITs, so real estate. So this is Fundrise. We do have a number of other articles comparing different exposures to real estate by not investing directly into property. So investing directly in property has a number of advantages, so tax advantages and things like that. However, it does take a sizable chunk of change. So there's a number of startups out there that are trying to democratize real estate ownership and make this a lot easier. So Fundrise does crowdfunding of real estate properties. So this means that you can own a fractional ownership of a large real estate investment. So something like an apartment complex or a hospital. Through Fundrise, you can now own a small share of that and reap the benefits of owning a sort of real estate property like that without spending a couple $1 million to invest in these. So private REITs have been around for a long time. This is just an online equivalent with much lower minimums. You can invest $500. It's very easy to do. So with everything, there are a number of advantages and disadvantages. So the advantage is, the big one is that you're getting exposure to this previously hard to get asset class. The disadvantages are it's not as structured in a tax optimized manner versus directly owning real estate. There's limited liquidity. It is privately traded. So there are some liquidity measures, but it's not like a publicly traded REIT. You can't go out and sell it for cash all the time. But what this also means is that it potentially will have lower correlation with the markets. So if the publicly traded markets go down by 50%, these assets with lower liquidity might not go down as much. It might be a product of lower liquidity, but at least in my mind, it's a little less correlated to those and decreasing my risk overall and adding an uncorrelated asset to my investment portfolio. So that's Fundrise. Next is lending. So peer-to-peer, uncollateralized personal loans. So for this, I was using Lending Club. So I'm no longer adding any more funds to this. Most of these were 3-year personal loans. They're uncollateralized. They're taxed as ordinary income. So from an after-tax perspective, for the amount of risk you're taking with these, it didn't really seem worth it in my opinion. So my total return here was 5.5%. I was expecting something more like 9 or 10%. So I had a lot more defaults than I thought. It is a very interesting asset class. I do think that there's a number of hurdles to work out and that it might make sense in the future. But right now, for 5.5% pre-tax yield, there's a lot of other investments out there that look more attractive to me from a risk return perspective. So that one is Lending Club. Lastly, follow us for more at Invest in Alts on all of the socials. So Instagram, Facebook, and Twitter. We're putting out a number of different content pieces, experimenting with video or slides or blog posts. We always will have a long form blog post associated with these videos, so you can follow along and find links and more information to everything we talked about in the video.
Thanks for watching. More and more investment opportunities and products exist, and more are created every single day. These products are giving investors access to previously hard to get or non-existent tools and investments. We're cutting through the noise to deliver viable options to the forward-thinking investor like you. Thanks for watching.